Yo, what's up, guys? It's your boy Looney, and today I want to break down something that affects every single investor, even when you don't realize it: inflation. And it's one of those words everyone throws around. You hear CPI, Fed cuts, rate hikes, but few people really understand how it quietly shapes your portfolio. So in this video, I'll break down how inflation actually impacts your money and what's going on right now with the Fed and this crazy macro backdrop. But before we get into this video, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month, and you get access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links are in the description. So let's actually start simple. When inflation rises, the buying power of your money falls. So let's say your portfolio gained 6% this year, or in my case, 41%, but inflation ran 4%. Your real return isn't that 6%. It's closer to 2%. And that's kind of the sneaky part. You could feel like you're winning, but your cash is actually stretching less. And holding too much cash becomes even riskier because it slowly loses value over time. So in my portfolio, I do keep cash, but I'm using it for flexibility. And I don't let it just sit there forever. It's there to deploy when opportunity shows up, if a stock is oversold or just a setup is there. But it's not there to beat inflation on its own. It's really there for just being readily used. It's there so that if there is some kind of opportunity, I will quickly jump in, maybe not deploy all my cash, but I will deploy what I feel is appropriate. Now, the second part, let's talk about the Fed. And you could actually bet on the Fed's decision and because they decide what the interest rates are for December, and inflation is affected or affects the rates as well. So I want to talk about how inflation really starts to impact markets with the Fed. Because right now, everyone is watching the December FOMC meeting, and Jerome Powell made it clear that a December rate is not guaranteed, or cut is not guaranteed. And the reason for this is because the government has been shut down, and this has actually delayed and limited a lot of key data, especially on inflation and also unemployment. So the Fed doesn't have the full picture. And without reliable data, Powell said that they're hesitant to move too quickly. So even though the market wants another cut, we might not get one for December. And that uncertainty is exactly why markets can be choppy sometimes. Because traders are trying to price in inflation risk without knowing what the Fed will do next. Because if they cut rates or interest rates go down, inflation goes up. And if inflation goes too hot, then they will have to increase rates. They'll have to increase rates, and that will affect your portfolio. They'll affect growth stocks, crypto, and yeah, let's get into that part, because how inflation can reshape your portfolio's performance is important. Because when inflation runs too hot, rates stay higher for longer, and it changes the parts of your portfolio and how they do. So if we look at like growth stocks, and I have a bunch of those. So I have SoFi, Robinhood, and a few others, Riot, Mara. These usually struggle because higher rates actually hurt valuations. The other part is value and dividend stocks actually hold up a little bit better because they produce steady cash flow. Something like Amazon is a good example. This is something that should hold up a lot better than some of those growth names like you saw that I just mentioned before, like Hood or SoFi. Those are the two. I'd consider Riot and Mara kind of growth stocks. They're more in the crypto space, so it's kind of hard to distinguish what those are. And they are transitioning to data centers, so I'm only going to mention SoFi and Hood as kind of my growth stocks, and those will struggle, but the value and dividend stocks like Google or Amazon, they should do a lot better, and also ETFs should be holding up a lot better than the other risky assets. But that doesn't mean they are immune to it. They will definitely go down and they will definitely be affected, just not as much as growth stocks. And actually, the last part is commodities and Bitcoin or crypto, because crypto, they've said that it acts as a hedge to inflation, but it's not always true. We've seen historical data that Bitcoin isn't really, or crypto isn't really a inflation hedge, so to speak, but it does get affected because it's the crypto market or the crypto world is based on global liquidity. And when inflation rates are high and the interest rates are high, there's less cash out there, less liquidity, and there's less ways to drive up the price. So often crypto and Bitcoin pull back, and they pull back pretty significant. So inflation doesn't kill everything, every single investment equally, but it just reshuffles who wins and who lags. And yes, you can look at like bonds and go the safer route. That's not really what I like to do. I kind of just hold cash. That's really my strategy. And this is how I'm personally managing inflation or inflation risk. I do keep some cash ready to take advantage of red days or just opportunity, but I'm not sitting fully in cash. You can see here 11,000 out of my 67,000. That's around 15% in cash. So not a lot. I know someone like Warren Buffett has like 30% in cash. He has billions in cash. So he is actually planning for a major crash, or I'm not too sure why he is holding so much cash, but that's what's speculated. Number two is I'm still doing my same strategy. So I'm doing the selling options, dollar cost averaging, just to stay invested. Because yes, inflation is a risk, but holding cash is a risk. And you don't want to be caught on the sidelines when the market or just everything shoots higher. And I'm not going all in, but selling options is that consistent income. And usually volatility is good for selling options. And there should be a lot of volatility coming up. October was a super volatile month, and we'll see. We'll see where the rest of Q4 heads. And the last thing is just staying balanced between high growth and steady value plays. Because if I'm all in growth, my portfolio will pull back pretty significant when there's inflation risk. And yes, my portfolio is heavier in growth stocks, but I do have some safer investments like ETFs and Amazon and Google. And maybe I'll take profit on those if we do go into like a bearish trend and transition those profits into something else. So the real key is thinking in real returns and not just nominal ones. Because if inflation is 3 or 4% and you're earning 5% per year, your actual gain is really small. So your job as an investor is to outpace inflation consistently. So not just green numbers on a screen. So yes, inflation may seem invisible, but it does shape everything. The Fed's move, the market sentiment, and your overall portfolio. And with the government shutdown limiting data, the next rate cut or next rate decision is uncertain. So this is the time to stay patient, stay diversified, and just overall be aware of these things. Because inflation doesn't crash markets overnight. It just slowly reprices everything. If you found this video helpful, drop a like, subscribe, and let me know. How are you adjusting your strategy heading into the next months or the FOMC meeting in December? Until next time, peace.